This LOS is explain issues that analysts should consider when examining a company's inventory disclosures and other sources of information. Evaluation of inventory management. Financial statement disclosure provides information regarding the accounting policies adopted in measuring inventories, the principal uncertainties regarding the use of estimates related to inventories, and details of the inventory carrying amounts and costs. This information can greatly assist analysts in their evaluation of a company's inventory management. These disclosures may provide signals about a company's future sales and profits as well. For example, a significant increase attributable to increases in unit volume rather than increases in unit cost in raw materials and or work in process inventories may signal that the company expects an increase in demand for its products. This suggests an anticipated increase in sales and profit. However, a substantial increase in finished goods inventories while raw materials and work in process inventories are declining may signal a decrease in demand for the company's products and hence lower future sales and profits. Analysts also should compare the growth rate of a company's sales to the growth rate of its finished goods inventories, because this could also provide a signal about future sales and profits. For example, if the growth of inventories is greater than the growth of sales, this could indicate a decline in demand and a decrease in future earnings. The company may have to mark down the selling price of its products to reduce its inventory balances, or it may have to write down the value of its inventory because of obsolescence, both of which would negatively affect profits. Inventory write-downs may have a substantial impact on the company's activity, profitability, liquidity, and solvency ratios. It is critical for the analyst to be aware of industry trends towards product obsolescence and to analyze the financial ratios for their sensitivity to potential inventory impairment. All you need to do is Google search inventory write-down for RIM, and you'll see that with their playbook they had like a $500 million write-down. So this is quite important. When conducting comparisons, differences in the choice of inventory valuation method can significantly affect the comparability of financial ratios between companies. A restatement from the LIFO method to the FIFO method is critical to make valid comparison with companies using a method other than the LIFO method, such as those companies reporting under IFRS. Analysts should seek out as much information as feasible when analyzing the performance of companies. So we've seen this slide before in a previous LOS, but we'll just show it again with regards to the presentation and disclosure. Some of the things that the analyst would look for are the accounting policies adopted in measuring inventories, including the cost formula, the inventory valuation method used, like LIFO, FIFO, specific identification or average weighted cost. The total carrying amount of inventories and the carrying amount in classifications, for example, merchandise, raw materials, production supplies, work in process, and finished goods, appropriate to the entity. The carrying amount of inventories carried at fair value less cost to sale. The amount of inventories recognized as an expense during the period, the cost of goods sold. The amount of any write-down of inventories recognized as an expense in the period. The amount of any reversal of any write-down that is recognized as a reduction in cost of sales in the period. The circumstances or events that led to the reversal of write-down of inventories, and finally, the carrying amount of inventories pledged as security for liabilities. And that's the last slide for this LOS. Thank you.